Good afternoon, everyone. Welcome to this M&A track on Inside 2020. Thank you for listening in. My name is Lee Mitchell. I advise on event-driven strategies here at SocGen in Singapore, and I'll be your moderator for the next two presenters, where we can look forward to hearing two M&A-related trade idea presentations. SocGen are a proud sponsor of Insight 2020, and we also work very closely with Smartkarma via our unique equity research partnership here in Asia that really does deliver fantastic insight and intelligence to our customers daily. Now, we have a wonderful speaker with us today, someone who really, I think, leads the way in terms of M&A and special situations advisory here in Asia, and that's Travis Lundy from Quiddity Advisors. Travis has over 20 years of experience as both a portfolio manager and analyst, with a focus on alternative strategies, including event-driven, catalyst-driven ideas, and a whole lot more. I think Travis really needs no introduction to anyone trading event-driven ideas here in Asia. And with that, we say hello to Travis and welcome. Thank you for joining us.
All right. Normally, I would look at event-driven as being a big thing. Call it M&A, call it restructuring. In this particular case, because Smartkarma asked for an actionable idea, I went with something which I think is actionable in the capital markets, is highly liquid, and has a flavor of restructuring to it. This is SoftBank's Bigly Buyback. SoftBank has been in the news for the last couple of years, largely because of the Vision Fund. I argue that Vision Fund and its newsworthiness create a kind of a split identity for SoftBank. Elliott management effectively leaked that it owned $3 billion of SoftBank just over 3 months ago. That caused a great deal of excitement. Then we saw the market downturn for COVID-19 in the middle of March, with SoftBank shares trading in the mid 3,000s. The company announced a 500 billion yen buyback, which was equivalent to about 6.5% of shares outstanding. And then just 10 days later, with the shares even lower, the company announced a 4.5 trillion yen asset reduction and capital restructuring program, which would include 2 trillion yen of additional buybacks and about 2.5 trillion yen of debt reduction, or net debt reduction. So let me just move forward on this. SoftBank has its good points and its bad points. SoftBank has what I think is arguably the best VC investment in history. If it's not Naspers in Tencent, it's SoftBank into Alibaba. It is now worth something close to $145 billion. That's after they've sold roughly a third of their position. If they'd never sold any, it'd be worth $200 billion plus. Another great investment was that it bought what is now called SoftBank Corp, was originally called Vodafone KK, from Vodafone, with an equity check of about $3 billion, if I remember correctly. It got vendor financing for close to $4 billion and got a whole business securitization package of loans for $10 billion, and that's been something like a 20-bagger plus for SoftBank in terms of what the asset is worth today in market price and what the dividends it has paid over the years. It owns a lot of other stuff. According to the earnings release yesterday, the package of net assets is worth something like $202 billion. The market cap of SoftBank to own that $202 billion worth of net value, net shareholder value, is something like $87 billion. Another good point now is that everybody knows what SoftBank is. This wasn't the case 15 years ago. People had much less clarity on what was in the pot. There's a lot more clarity on what's in the pot now. The bad points. Everyone knows what SoftBank is. SoftBank is a big cloud of stuff. It owns a lot of stuff. More recently, though, I think the bigger issues have been that, one, SoftBank has a self-identity which is not, strictly speaking, coherent. Masayoshi Son named his vision fund the Vision Fund precisely because of his idea that he had a vision for the future. He had a 300-year horizon. The trading activity inside the fund doesn't show that, and it's not clear that the way SoftBank and Masayoshi Son present their business and their vision, it's not clear that that is compatible with what they're doing. In big figure terms, SoftBank is, as of the shareholder presentation, $202 billion worth of shareholder value. Of that, $137 billion is Alibaba, $42 billion is SoftBank Corp, held across two different holdings. $30 billion roughly is the stake in T-Mobile, now that T-Mobile has merged with Sprint. $25 billion is the Mark II model of the ARM investment, and $24 billion is the SoftBank Vision Fund on an NAV basis for their particular stake. There's a little bit of extra stuff thrown in there. Now that Alibaba has gone up here on the Hang Seng news and general bullishness in the States, Baba's now 70% of the pot, of the NAV. SoftBank Corp and T-Mobile generate decent equity affiliate earnings. SoftBank Corp generates decent cash flow, but all of that is outside of SoftBank itself. SoftBank itself doesn't generate that much in cash flow other than the dividends from SoftBank Corp. That's the big one. If you look at the assets as a pile, in the earnings yesterday, they announced a sale of Alibaba shares through Collar and Forward, and there was a Wall Street Journal article suggesting that they could sell a large stake of their T-Mobile position to Deutsche Telekom. I argue that it's possible the entire stake could be on the table. If you look at this differently, Masayoshi Son tries to present SoftBank as a vision for the future. All of the existing holdings are in some way designed to be avatars of good investments for the way the world will be. He has a very expansive self-concept. He has talked about his vision living 300 years. He's a 100-year investor. He looks at chips. He looks at AI. He looks at software. He looks at all kinds of things. Yesterday, he decided that the Vision Fund was something which would tackle the biggest challenges and risks facing humanity today. This is a big dream. The split identity for SoftBank comes where, in fact, 90% of SoftBank's assets, which they describe in their in the gross assets of the shareholder value, 90% of that is actually run by other people. That is to say, it's got different groups of CEOs, different groups of salespeople, different groups of clients. SoftBank Group is responsible for none of it. They have equity association, but there's nothing which says that SoftBank has any significant control over Alibaba, one could definitely argue they have control over ARM, but that's not necessarily a good thing. Leaving it to management would be a better thing. T-Mobile, they stand back. They even give their proxy to Deutsche Telekom. And SoftBank Corp is run by a relatively independent-minded CEO, Mr. Miyoji. Where Masayoshi Son, who is the leader of this giant pile of assets that he's trying to convince you to own, where he exercises his vision is inside the vision fund itself. He also exercises his vision in terms of selling the other 90%. He's not going to buy any more of that 90%. It just comes down to selling it. I would argue that SoftBank has an image problem right now, which is that even if you go to, if you look at all the media coverage that SoftBank has enjoyed, in quotation marks, over the past 3 years, 90% of it has been tied to the Vision Fund. It's been tied to the new model. It's been tied to infighting. It's been tied to executive changes. It's been tied to the ups and downs of some of the investments. It's been tied to Uber, WeWork. People have made fun of them injecting a few $100 million into a dog walking enterprise. And now they've let a satellite company go down. Other things which have been an issue have been the control issue. Who controls the Vision Fund? Is this Masayoshi Son kind of shooting at from the hip? Is it a bunch of former Deutsche Bank investment bankers or credit people? What's the control here? Who's actually exercising it? There's been issues of infighting between executives. I am sure there is a tell-all book here by at least one of the major journalists following this story. I think it'll be great fun to read. However, when you think about that ex ante, do I want to own that thing where the most fun will be actually reading that tell-all book in 10 years' time? That's a good question. There are other issues with co-investments and conflicts. One is never sure when it shows up in the paper which entity is buying, whether it's 4 different entities or 3 different entities which are buying. Is SoftBank buying? Is Sonsan buying? Is Vision Fund buying? And when they get spread back and forth between these entities, is that a problem? And the answer is yes. The transparency on capital allocation and decisions around capital allocation are an issue for SoftBank investors. This is a shame. This is 10% of the gross asset value of SoftBank, and that's something which SoftBank really needs to fix. When Elliott came in, and the discount to NAV could have been argued to be in about 60%, one of the real things that can be done here is you can throw capital around and you can change your image. Changing your image is a thing which costs a lot less and should be at the top of Masayoshi Son's to-do list because he needs better coverage. Yesterday in the analyst meeting and in the call, it was very clear that most of the questions and uncertainties had to do with the Vision Fund, and it was clear that Masayoshi Son was unhappy that the tone was negative. It's clear that he wants to look through the valley of the shadow of the coronavirus unicorns and see beyond that because of all the great stuff in his portfolio. And he says, markets go up, markets go down. And he sees those moves as relatively small given the overall size of the $266 billion of gross assets. Yes, they're they're not very big. If you lose $10 billion on $266 billion, that's not a lot. A lot of investment funds did a lot worse in Q1 this year. However, he has to live with the way that the world perceives him. And if the world's going to give him a big discount because of Vision Fund, then he needs to fix that. As I argue on slide 6, the big issue here he needs to fix is stewardship and conflicts. He also needs to fix investment methodology and capital allocation. He doesn't want newspaper articles about them throwing $200 million at a dog walking company. The other thing he probably doesn't want is he doesn't want questions about why he personally decided to back $2 billion of stock to a 26-year-old. It may be that Oyo is the best thing since sliced bread. It's just not necessarily something which everybody else is going to agree is the right way to allocate capital. However, importantly, the public avatar of all this is the SoftBank stock, and Son wants the stock higher. He's long been disappointed with any discount which was larger than 50%, and in the depths of March we saw a discount which was probably close to 67, 68%. There are a couple of reasons for this. It could be that he's impatient with investors not giving him credit for his vision of the future. It may be that SoftBank's share price is the way he measures himself. And there's another possibility. He's promised to back a bunch of stuff. He's on the hook for a bunch of stuff, and a lot of that is actually funded by borrowing against SoftBank shares. He could conceivably be worried about margin calls. This new 4.5 trillion yen plan for debt, equity, and capital assets is designed to reduce gross leverage. It's also designed to prove that SoftBank can take profits and reallocate capital. It's a big buyback, and this is the main interest of the trade. I would argue that there's a significant chance for a squeeze here. The reason why there's a chance for a squeeze is that the company has announced a 500 billion yen buyback plus an additional 2 trillion yen buyback in March, which was additive, not replacing. And so far, the company has bought back 250 billion yen out of that 2.5 trillion yen. If you buy back another 2.25 trillion yen at current market price, that's 500 million shares. You can look at the company, the total, and you can say, well, there's 2.1 billion shares outstanding. That 500 million is 25%. However, that's not the way the world works. When you buy stock from people who sell. And people who sell include people who can sell. Obviously, Son-san, who owns something like 26% of the company himself, between 27% between his own personal holding and Son Asset Management, Son Corp, etc., his corporate affiliates. He's not going to sell at this discount to NAV. Most of the directors won't either. The couple of other corporates which are in there probably won't either. Passive investors don't sell when the stock price goes up either, and there are a lot of passive investors in SoftBank. If you look at the yellow lines on this table here, the yellow lines are the people who could sell. That says that there are a total of 750 million shares who could sell, and if the stock remains at the current price and they buy back all 2 trillion yen, 2.25 trillion yen, that would be roughly 500 million shares. That would be a buyback of 2/3 of the active ownership of the stock.
Hey, Travis, can I just butt in there?
Yeah.
If we could try to wrap up in the next 4 minutes, because
sure.
it'll be good to leave 5 minutes Q&A, but that's a lot of free float that could be removed. But do your best to.
So the way I look at this is I see a relatively easy funding on this. $11.5 billion from Baba has already been done. I think 30 billion of T-Mobile is available. Deutsche Telekom could buy some to lift its stake above 50%. I think it'd probably buy a little bit more to lift to 55 to 60. And I believe that SoftBank could do a mandatory exchangeable trust security the way they did for Alibaba 3+ years ago. An additional stake in SoftBank Corp would be available because they currently own 67%. They could go down to 60, I think, reasonably easily. I expect the debt buyback to be conducted through auction and through a lack of rolling of existing financing. If you look at a model of the way the buyback would work, buying back roughly 150 million shares under the current 500 plus 250 billion yen. And then if you did an additional 500 billion yen buybacks, that would reduce your number of shares by a total of 400 to 500 million shares, depending on where you buy them. If you buy them at current price, it's about 500 million shares. If you buy them at a steadily rising price, it's about 400 million shares. Even 400 million shares is 55% of float. I think that it is a somewhat difficult to model how much of a price impact that has, but it must be remembered, Son doesn't want to sell anywhere near here, and the passive investors don't sell when the price goes up. Eventually, short sellers may add to the supply. They borrow shares from the passive guys and they short sell in the market. That means that active holders don't need to sell as much. However, there is a lot of active holding which could go out of this. I view a 30% rise because of this as a relatively easy thing to accomplish if they actually go through with the share buyback in full. The risks on this are that something bad happens to Baba. Alibaba has, as far as I'm concerned, the possibility of governance risk, the possibility of accounting risk, the possibility of US listing risk. It is mitigating that somewhat with the secondary listing in Hong Kong. The new Hang Seng rules on weighted voting rights stocks will mean that there's more demand in Hong Kong. And we could see a relatively large move of similar China internet companies moving from NASDAQ to Hong Kong. This could lift valuations and could lift demand. SoftBank Corp is another big thing. I would look at Mio Kato's analysis earlier today. I believe that it's somewhat healthily valued. I think it's probably got a little bit more goodwill than does KPI, but I think that it's probably okay for the next year, and I would call that a mitigant. SoftBank Corp is a stable-ish business, and Z Holdings, Zozo, and Line are not indebted enough to cause a serious problem. The other really nice mitigant for SoftBank and all of its assets is all of its major assets are not terribly badly affected by COVID-19. So that's something I think of a positive.
We better get to these questions in a second.
The end of the buyback leaves active holders holding about 25% of the company, and that is a low number. I'll leave the questions.
Yeah, let's do it. We're down to our last 4 minutes here. So we've had about 5 or 6 questions come in on the platform. So let's see how quickly we can kind of get through them. The first one is, how hard or easy do you consider their new $20 billion fundraise to complete the T-Mobile transaction? I think they're asking the likelihood of the T-Mobile sale going through, Travis, I think. How easy do you consider that to be?
I think that's not that difficult. T-Mobile's EBITDA, I think, is around, actually, I don't have that number off the top of my head. I'm going to say 25 billion dollars. Deutsche Telekom itself is about $24 billion. If they wanted to raise $20 billion, they could probably do so. Just our own.
Yeah, I think there's some news tonight that it's going to happen
Okay.
later this week. So
Okay, I haven't seen.
now we've got another question here. Would there be any details or educated guesses available on the forward collar transaction announced yesterday? That looks like a bit of a...
I think that, so the collar, the normal way you do a collar is you do it about a 70 delta. The fact that they have they have left $2.5 billion on the table out of the 11.5 suggests that the collateral value of the $8.5 billion collar is around $6 billion. That would indicate that it's about a 70 delta, because normally you would get the the bank would give you the cash of the delta of the collar, and the forward of $1.5 billion, you'd get the full $1.5 out of that. The floor you'd get out of that as well. So basically the $1.5 billion in the forward and the $1.5 billion in the floor, those are effectively already sold. The collar is somewhat similar to the Mets transaction. That is to say, if the stock goes down, you'll get a little bit less cash. If the stock goes up, you'll sell. You'll get a little bit more cash and sell fewer shares.
Yes, understood. I think I want to get to this question quickly. I think it's an important one. What does Elliott want? What's the end game for Elliott here?
Elliott wants a win. Obviously, they want to make money out of this, and they want to win. Importantly, this is not being done out of the Hong Kong office or Tokyo office. This is being done out of New York. This is, from what I gather, a position managed, quote unquote, by Mr. Singer's son. And that means that this is almost franchise defining. This is not an Alps Alpine thing. This is a real position, real activism, and they will stick with it for quite a while. This is something which I think they could hold for a couple of years. If the discount went from 50 to 40, I don't think they would sell.
Yes, and that leads me, I guess, into the last question. We've got 60 seconds, but Massa-san thinks the current discount is too wide. What is an appropriate discount to NAV on a steady state basis, do you think? And we've got 30 seconds.
I think the right number is somewhere between 40 and 50.
40 and 50.
I think that 50 is probably a little bit wide for a clean asset business. I think 40 is probably okay.
Got you. Travis, thank you so much. We're going to have to wrap up there. I apologize to the people that asked questions that I couldn't quite get to there. We ran out of time, but thank you again, Travis.